You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the aforementioned network. And if we sound a little bit different, it's because we're coming to you not from our studio in Chicago, but actually from the Options Industry Conference here in scenic and sunny Florida. It's a great event. It gives us a chance to really catch up with a broad cross-section. Easy for me to say. I've been doing these interviews for a few days. A broad cross-section of the options industry, brokers, exchanges, traders, vendors, and a little bit of in-between, which brings us to our next guest. He's a newcomer to the network and indeed to the program. He is Gary Franklin, the Vice President of Retail Options Trading and Strategies over there at Raymond James. Gary, welcome to the program.
Thank you, Mark. Thanks for the opportunity for being on the show today.
Let's start, Gary. It's your first time on the network. So as we like to do with all of our first-timers, give us a little bit of an overview of your background and how you found your way over to Raymond James.
Okay. Yeah, I always love telling the story that I've never, ever had a resume. It was a type of thing where, my father is now recently retired, but he practiced dentistry for many, many years, and one of his patients was the mother of the then head of capital markets. And so he said, hey, go see so-and-so. And, if you show up and you're good and you can do whatever they ask you to do, you're going to have an opportunity. So I actually started out as an intern with the firm in my senior year in college. And so I actually...
Oh, so you're a lifer at Raymond James then.
Definitely. So I started in 1990. With then Morgan Keegan, Southern firm based out of Memphis, Tennessee. So I was there from 1990 till the merger, which was around 2012. At that point, the decision was made for me to move down to Florida. They always joke at Raymond James, we pay you in sunshine. So I'm down in Tampa, Florida at the headquarters now, and it's awesome.
Of course, last year at Tampa, maybe not quite the payment you were expecting, a little bit of Mother Nature intervening there, but I'm sure it's much better now.
Exactly. Yeah, and actually we being a Florida-based company, we're always practicing and planning, and the disaster recovery teams, they take it very serious within the firm, and the culture is family first, right? It's all about the client, but then internally it's all about the employee and the experience that we have, and seeing the hurricane coming down, and someone from Tennessee, it was my first experience with it, seeing how the plans turn into real actions, and how, be at this point, meeting here, we're going there, we're going to our backup sites, it was seamless, and it really makes me proud of working at Raymond James.
So, Gary, we don't see a lot of Raymond James reps down here or executives here at the conference. What is it that brings you to the options industry conference these days?
So, and for me, I started trading options on my own in the early 90s before I was even part of the option industry. My love for this industry and the idea that no matter what the market condition is, whether we're in a bull trend or a bear trend or just trading sideways, options gives you the ability to create a strategy and benefit or protect yourself based on the scenario. So this is coming up, almost 20 years that I've been involved in the industry, and just seeing the evolution and the progress that we've made, it's amazing. And coming to this conference, year after year, and there's always a new challenge, right? And the challenges that we have now with the quality of execution, it's amazing. When I first started, you saw a quote on the screen, and you got one quote at a time. You had to phone down to your routing partner, and they would walk it out to the floor. You'd find out 5 minutes later if you got a fill or not, and it might be good for 10 contracts. And coming from that period in the early 90s to now, with the click of a button, a retail client can get all the analytics they desire and do thousands of contracts if they want. Obviously most of the retail clients are 20 or 30 contracts at the most, but the experience that they have is unbelievable.
It is. You're right. It has been amazing to watch that evolution. The other interesting evolution that's been kind of fun to watch for us personally, I'm sure for you as well, is the evolution of your neck of the space, the advisor space, into the options realm. And we first started, the Options Insider 11 years ago now, which is kind of hard to believe. Advisors were, they were nascent in the option space. They were very small penetration, very small percentage of the volume. Of course, a lot of outreach from folks like Eric and his team over there at the OIC. We do a lot of content aimed at that space now. We have a show called The Advisor's Option. It's been running for many years and gets a lot of traction. There's been a lot of focus from the industry as a whole on bringing that space up to speed and getting them to, awaken to the benefits of these products. I'm curious, from your perspective, you've been around the space, you live in it day in, day out. What are your thoughts on the evolution of maybe the interest, the wherewithal for options in the advisor space? Do you think it's really grown quite a bit? Do you think it has, more room to grow? What are your thoughts there?
First of all, let me just say the Option Industry Council, regional firms all the way to the big national firms, the value that they bring, the credibility that they bring, the education, the pure unbiased education that they give is cannot be measured. I mean, it's so important. And that, from me personally, coming as the industry grew, and as, to your point, the perception that advisors are not interested in options, the perception that clients are not interested in options, the Option Industry Council gave us the marketing materials that we needed, right, to go out and do the grassroots education to bring us to where we are now. And thanks to, shows like, shows within CNBC where they're actually talking about options every day. The surprising thing that I've known for a long time, but a lot of other firms and senior management in particular have finally realized, clients understand options. The idea that they don't is a falsehood, right? So, and then the other thing that I've discovered is advisors understand options. They might not implement it in their practice, but they understand the basics, and the basics cover, 80% of what we do. Cover calls, generating income, or buying puts to protect the downside. If you can do those two things for your client, that's huge.
You got most of it covered,
right?
Yeah.
You got most of it covered. You don't have to do anything exotic. You don't have to speculate, But knowing the basics, the clients get it, And I know rates are increasing, but at the same time, options can add, value, right? For me personally, for example, with my parents entering retirement, they might earn in a low-risk portfolio maybe 4%, right? If you can add options income on top of the equities that they own, suddenly they go from 4% to maybe 6%, and you're still in a low-risk scenario. I think that's huge. The way I always try to talk about it is, okay, to understand it, you own a stock. You collect 4 dividends a year. Wouldn't you like the 5th, 6th, and possibly the 7th dividend? Well, that's a covered call writing program. You create that ladder, and you sell a 3-month option. Wait 3 months. You collect that premium today, then you go do it again and again. So you're going from 4 dividends a year on that stock that you already own to, maybe 7 dividends a year. And once you do it and clients get it, the light bulb goes off and they're like, man, why have I not been doing this all along, right?
So it's interesting. You're saying that a lot of the maybe growth and adoption we've seen in the advisor space when it comes to options has been kind of bottom up and driven by client demand. You're saying the clients kind of get it. They're being able to wrap their heads around options, and they're saying to their advisors, hey, why aren't we doing this? So it's kind of been a bottom-up growth, which I guess is the way you want it to be, right? You want it
Correct.
to show that there's a demand there first, and then you can meet that demand. So that's kind of what you're seeing at Raymond James?
Yeah, definitely. When I came over there and really rolled up my sleeves and took my game plan from my previous firm before the merger, it's all about grassroots education. The clients get it, the advisors get it. You just got to tie those two together and grow. And one of the big things that we've seen over the last 3 years in particular is the proof of that process coming. So it's not only more advisors using options, but it's also more clients. So you might have your volume. Our volumes have been growing, right, around a 30% clip. But it's also the wider net of the usage. And to me, if you can build a bigger foundation, that's how you grow the business. And also offering. For us, there's some people that understand options on the client side and the advisor side, but offering a solution from the managed, like a money manager side. And the growth in that area is really picked up, and our advisors really love that because sometimes, they don't want to have to watch something every single moment. So if you can offload that to a manager and let them run a proven process, where it's repeatable, everybody gets the same experience, that's been a big growth area for us as well,
Now, you obviously have a lot of advisors over there at Raymond James. Is this a strong focus internally at the firm to get more advisors on board with options? Is there some sort of internal curriculum or educational program you guys do to bring advisors over? How do you guys handle that over there at Raymond James?
Definitely. One of the big focuses over the last couple of years is education. Right, so that's where you'll notice in my strategy, in my title, it's trading and strategies. And really, to be quite honest, most of it is strategies, right? So we've built out a pretty robust internal site for our advisors where, if they need brochures to review how cover calls work or watch a video, all that stuff is there for them. I mentioned earlier about there's so many tools available, analytics, where you can go in and you can simulate a trade, see what's going to happen, change days to expiration, change the underlying price of a stock, and really get comfortable with what could happen. That's been our main focus. And we take all of our internal research lists and we say, okay, you like this research list that we're offering? What if we added a cover call on top of it? We do that. We have put writing lists. If you were going to buy this stock today, one of the things that I always try to promote to people is if you bought a stock, right, say it's a $50 stock, and you bought 100 shares, you're putting up $5,000 on the line. But what if you sold a put for the right to acquire a stock? Let's say at 45. Someone's going to pay you maybe $1 for that, and you go out 2 months. Your average price is 44, whereas the guy that just bought the stock, their all-in cost is 50. So you've reduced your risk. Obviously, you if the stock goes straight up, you don't have the benefit of that upside move. But if you're willing to take, smaller risks and collect that premium, it's a much better experience in my piece. And kind of talking through like when to use the right strategy, that's also a big part of what we do. So like last year, the market went straight up, okay? So call writers potentially had a bad experience. But the way I look at it, it's like, wait a minute. If the stock was at 60 and you sold a $70 call and you got paid $1 and you got called out, you didn't lose money. You made money. Now, you can't factor in greed. But at the end of the day, you understood when you went into it because we give the education. So you made 10 points on the upside of the stock. You already get paid $1 in premium. That's not a bad day. Now, if the market was up 25% and you were only up 20, okay, yeah, you lagged the market. But 20% on in a year, that's not bad.
Never look the winners in the mouth, right?
Exactly.
Well, you're right when you're saying these things. People have this perception, particularly in the advisor space, that options are still of these complex things. But you're right. If they do these basic steps of, substituting a short put for their limit buy order in a stock or using a covered call to sell their stock, these basic steps are dramatically impactful to their portfolio going forward.
Keep it simple is so
important.
important.
Let alone learning things like protective puts and then combining them together with collars. Like, you're right. If you combine those two positions, the covered call and the protective put, you have 75% of what the entire wealth management industry is doing. You don't need to go really beyond that. And then maybe the short put to get in. You add all those things in, and you pretty much you don't even have to go crazy iron condor ratio swaps or anything along those lines. Just keep it basic,
right.
And it covers the lion's share of what you and, more importantly, your clients are going to want. Talking about the clients and you mentioned kind of the markets, how they've been moving of late. It's been kind of a turbulent period. Last year when I ran into this conference, it was a much different event last year. It was just much more dire. There's no volume. Volatility was in the toilet. Everyone was kind of wringing their hands. Where is the volume going to come from? What's going to happen? The outlook was very bleak at last year's conference. Fast forward a year. Volatility came back, maybe a little bit faster than some people expected, but it is back. Volume is through the roof. I think year to date, the industry's up like close to 30%. Obviously, that's not sustainable, but still a good start to the year. So people here have a little bit more of a spring in their step this year. I'm curious, what's the last few months been like for you and your clients and your advisors over there at Raymond James when volatility, and obviously February 5th and 6th, the market sold off aggressively. Volatility roared back to life. We've been in a much more volatility-centric regime ever since. How's this been for your clients and your advisors? Are they maybe backing off a little bit? Has this been too much too soon? Are they kind of saying, "Whoa, I want to take my ball and go home" a little bit? Or are they intrigued by this for the the premium harvesting and the other things you were talking about before? Is this more of an opportunity for them?
Definitely. A couple things on that topic. Thinking about different strategies based on different markets. So, everybody was big on selling calls last year when they really should have been selling puts into that bull market, right? So now you're seeing where some people are feeling kind of burned about a covered call writing program, which in reality, they should be doing it now, right? We're getting into that market that should be where you want to capture all that premium. So it's funny, I do a monthly call with to our advisors where we kind of talk about what's going on in the market. And we, back in January, I was pulling this up the other day. I said, this was before everything started going crazy. I said, the markets had been going straight up, but I just have this feeling with earnings that when is good and great, not good enough. And then within like a week or two, things started going crazy. So, it's actually healthy for the market to go through these times. We got so comfortable with a slow grind higher. But the reality is that's not good for people. They get too complacent and think that that's just the way it is. So understanding that, you need to still have that put protection. We were touting, hey, don't forget to use our put calculator if you want to do a portfolio hedge. The volatility is very low, so you can it's cheap to put on this protection. Because if your house is on fire, you don't want to buy it the day your house is burning down. You want to have it in place already. So kind of fast forwarding through all these turbulence, we're seeing the good side of heightened volatility is the premiums are coming back to life. Because at the end of the fall last year, you were saying, oh, let's go sell covered calls 3 or 4 months out and collect 20 cents.
Yeah, it wasn't the most exciting thing in the world.
No. It's not a good scenario. But now that very same trade, you might collect 70 or 80 cents, maybe even $1, and still have 10 or 15% upside on the underlying stock. So it's this new normal that we're embracing is really healthy for everybody and healthy for the income generation folks.
One of the big topics at the conference here this year has been the issues with liquidity in the options space. We see the data every year here at the conference that a handful of names, somewhere around 20, dominate the space. They do roughly half of all the paper. And then once you get beyond that 20, it falls off pretty precipitously. And this has been covered in this has been a topic at the conference for years, but it's getting a lot more mainstream coverage of late. In fact, our audience coming down here, when we polled them about what they wanted us to talk about, over half said they wanted to talk about, options, liquidity issues. Is this a concern for your team over there at Raymond James? Are you starting to hear from the advisors who are doing all the right stuff? They're learning about covered calls and protective puts, and then maybe they pick a name game outside those top 20 and they realize maybe it's a little bit hard to execute that? Is that something you guys are concerned about?
So, there's always concern about market structure, right? So from the advisor side and the client side, there's 15, soon to be 16 exchanges, but they don't really need to know. All they want to know is when we put this order in, if the market's $1 to $1.10 and they put in a limit order to sell at $1, that they're going to get that dollar. They don't have to know what exchange it went to. They know I'm good. That experience is vital to them. And with us, we really push hard to try to improve that order. If it's $1 to $1.10, we're wanting to get it better. Okay, can we get $1.01? Can we get $1.02, $1.03? So they really love the idea that we have a strong relationship with our routing partners in the exchanges to get better than what you see on the screen. That's a good experience. Now, the concern from my side is I've built up this trust with my client. And the fragmentation that we're seeing in the industry is a concern. When in the old days, as you know, a market maker stood up when the storm was brewing and the clouds were overhead. Now, with the current market structure, the market makers are fewer and fewer. So who's going to stand up if something bad happens, right? The professional traders don't have the same obligations. So I think, and I'm very proud of our industry, there's a lot of smart people here. They need to roll up their sleeves. These exchanges need to work together to say, look, market makers need to be able to stand up in the bad weather, right? So that means they also are entitled to making a healthy return on their, on their risk. And if we need to find a happy medium there, I think we go from extremes from one end to the other, and regulation is good, market structure is good, but it needs to have an incentive for these guys to stand up, because we want them in bad times. We want them to be great and be there in good times, but as we've seen recently, when things go bad, nobody's there to stand up anymore. That's the downside of it, but the industry is much larger than it was 10 years ago or 20 years ago, so that everything's there, but we do need to get the smart people in the room, get the exchanges to meet together and come up with a plan, because that's the next level for us for growth. I mean, we've gone from 1 million contracts to 10 million to 20 million. Well, how do we get from 20 to 40 or 50 million? To me, that needs change in the industry.
Yeah, it's been interesting because that's been a behind-the-scenes topic at conferences like this for many years, but now it seems like that's really spilling over into the mainstream, which is both good. That shows that options penetration is growing and people are savvy enough to get down the rabbit hole enough to discover these issues. But also it's bad, obviously, because you don't want the public perception being that these are thin markets for the most part and you can't really trade them. So, yeah, clearly if it's reached that saturation point, then it probably is time collectively for people like you mentioned to roll up their sleeves. Maybe not here in Florida because I'm not wearing any sleeves, but roll up their sleeves and get to work on this. Well, Gary, like I said, I'm glad to have you on the program finally and see what's going on over there at Raymond James. That said, if there's maybe an area we didn't hit on the conversation today, or perhaps you want to leave our listeners with a little bit of a hint, a little bit of a tease of what's coming down the pike from you and your team over there at Raymond James, now is the time, sir. The floor is yours.
So, for me, everything's about grassroots education, right? Generating income, adding protection, providing the tools that they need. That's what we're all about, and the firm's been growing organically through some acquisitions as we move along. But the future looks really bright for us.
Well, Gary, like I said, I'm glad to have you on. I'll look forward to seeing how all these developments unfold over there at Raymond James in the coming months.
Thank you. Thank you for having me.
Great. Thank you.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/the The Options Insider or via questions@theoptionsinsider.com.